Hello, everyone. Welcome. Today, we're going to break down one of the most critical topics you'll face in strategic financial management, interest rate risk. So let's get right into it. So take a look at this number, 117,764. Any idea what that is? Well, that's how many candidates appeared for just Group 1 of the CA Intermediate exam in a recent session. The competition is, let's be honest, absolutely fierce. And mastering the fundamentals of this topic, that is how you're going to get a real edge. So let's just dive right in. My aim here, and I'm speaking as someone who sets these acronyms, isn't just to get you to memorize a list of definitions. It's to help you build real conceptual clarity. Because trust me, that's the absolute key to tackling any problem they throw at you, not just in the exam hall, but in your career down the line. Okay, first things first, we're going to build the foundation. You've got to know your enemy, right? Before we can even talk about managing risk, we need to get a really good handle on what exactly we're up against and the different forms it can take. Think of it like this. You need a clear diagnosis before you can prescribe the right cure. So what is interest rate risk really? I know the definition on screen sounds a bit academic, but in simple terms, it's all about uncertainty, plain and simple. When interest rates bounce around, and believe me, they always do, it directly impacts the cost of borrowing money and the income you earn from lending it. That fluctuation creates risk for everyone, especially banks and big corporations. Now, if you open up the official ICAI study material, you'll see a list of 7 different types of interest rate risk. And I get it, that can look a little overwhelming, but don't be intimidated, okay? For the purpose of the exam, and frankly, for most real-world situations, we're going to zero in on the big 3. These are the ones you'll see again and again in case studies and problems. All right, let's start with gap risk. This one is absolutely crucial for banks. Here's a simple way to think about it. A bank's assets, those are its loans. Its liabilities, that's your deposits. Now, what happens if the interest rates on their loans reprice more often than the rates on your deposits? Well, if market rates suddenly drop, that bank's profit margin, its net interest income, could get squeezed big time. That mismatch, that's the gap. Okay, next up is basis risk. Now, this one's a little more subtle. Imagine a company takes out a loan and it's tied to one benchmark rate, let's say Maybore. But, and this is the key part, the money they're using to fund that loan is tied to a different benchmark. What's the problem? Well, if those two benchmarks don't move perfectly together, and they almost never do, the profit spread the company was counting on gets squeezed. And that, right there, is basis risk in action. And the third one we're focusing on is price risk. This all comes down to that fundamental rule you have to know inside and out, the inverse relationship between bond prices and yields. It's like a seesaw. When interest rates go up, bond prices go down. So let's say you're holding a bond and market rates suddenly shoot up. All the new bonds being issued now have a better return, right? That makes your older lower rate bond a lot less attractive. So if you have to sell it before it matures, you're going to take a loss. All right, so we've diagnosed the problem. We know our enemy. Now let's talk about the solutions, your hedging toolkit. And for the exam, this is really important. You need a framework. You have to organize these methods into clear categories. Why? Because it shows the examiner you have a structured way of thinking. And here is that framework. Think of this as your mental map. On one side, you've got your traditional methods. These are all about managing the balance sheet itself. Things like asset and liability management. Then, on the other side, you have the modern methods. This is where we get into derivatives, futures, options, swaps, sophisticated tools that let you manage risk off the balance sheet. Okay, let's really bring these concepts to life now. We're going to take one of the most versatile and, yes, one of the most frequently tested modern tools and just demystify it. We'll use a simple, practical example so you can see how this stuff actually works in the real world. So think about this for a second. What if a borrower could be protected if rates go up, but still get the benefit if rates fall? I mean, it sounds like having your cake and eating it too, right? Because if you lock in a fixed rate, you get certainty, sure, but you lose out if rates drop. Well, this is the exact problem that an interest rate option is designed to solve. It's basically like buying an insurance policy for your interest payments. And that brings us to the interest rate cap. Here's the crucial point. A cap gives you protection against rates going through the roof. But, and this is the magic part, you are not locked in if rates fall. You get the upside potential if rates go down, without the downside risk if they go up. Of course, this protection isn't free. You pay an upfront premium for it, but it really can be the best of both worlds. Let's walk through this. It's pretty straightforward. Step 1. A company buys a cap with a strike rate of, say, 8%. Step 2. The market rate shoots up to 9.5%. Ouch! But wait. Step 3. The seller of the cap pays the company the difference, that 1.5%. So the company's interest cost is effectively capped at 8%. It's brilliant. But what if the market rate had fallen to 6%? Simple. The company just lets the cap expire. It's worthless, and they get to enjoy paying that lower 6% rate. That flexibility is exactly what they paid the premium for.
Okay, so once you understand a cap, the other pieces fall right into place. If there's a ceiling or a cap, there's also a floor. An interest rate floor does the opposite. It protects a lender from rates falling too low. And then you have the interest rate collar, which is a really clever strategy. A borrower buys a cap for protection and at the same time sells a floor. The money they get from selling the floor helps pay for the cap. The end result? They've limited their risk within a specific range, or a collar, often for a very low cost, sometimes even zero.
All right, to wrap things up, let me give you some final advice. I'm going to put on my examiner's hat for a minute and share some perspective from my side of the table. This is all about how you can turn what you know into marks on the paper. I absolutely cannot stress this enough. The ICAI study material is your foundation. It's the Bible. This is the #1 piece of advice from every single rank holder for one simple reason. Your entire exam is based on this material. Know it backwards and forwards. Solve every problem in it. If you do that, you've built the strongest foundation possible. And my second piece of advice is this. Focus on the why, not just the what. Seriously. Just memorizing the formula for an FRA or a swap isn't going to cut it. As examiners, we create problems to see if you get the bigger picture. We want to know if you understand why a company's treasurer would choose a cap instead of a collar. What are they trying to achieve? What risk are they trying to mitigate? That's the higher level thinking that gets you the big marks. So I'll leave you with this question. Just think about it. A company has a huge floating rate loan. Which instrument gives them protection if rates skyrocket, but also lets them keep the opportunity to benefit if rates fall? See, that question really summarizes the core strategic decision we've been talking about today. The answer isn't just a word, it's a concept. It's about managing risk while preserving opportunity. Master that concept, understand the why behind these tools, and you are well on your way. All the very best.